Beijing just pulled a lever that's set to completely rewire the global financial system for decades. And if you're not locked in on what's happening in plain sight, you're going to wake up one day completely blindsided asking how the world changed so fast while nobody gave you a straight answer. What we're witnessing is a move that has been the quiet nightmare of American leaders for a very long time. It's a domino that experts in Washington have been watching wobble for years, and now Beijing has finally tipped it over. They began offloading US Treasury bonds at a scale we've never seen before. Look, I get it, for most of you this sounds like boring financial jargon, the kind of stuff that's only meant for Wall Street suits or bureaucrats inside the Treasury Department. But I need you to understand this with absolute clarity. The event that just unfolded is a far bigger deal than any election cycle, any political soundbite, or any headline that has crossed your screen in recent memory. This represents a seismic shift in the architecture of global economic power. And the shockwaves are going to hit your daily life, your job, the money in your savings account, and the very shape of your future, whether you choose to pay attention or not. So let me show you exactly what's going on and why this demands your full attention right now. For more than 50 years, ever since Richard Nixon severed the dollar's last tie to gold back in 1971, the US has operated with a special power that I and many other economists who dare to look behind the curtain call the dollar's exorbitant privilege. This isn't a level playing field, and it's certainly not a system built on merit alone. It's a framework founded on a massive built-in advantage that allows the United States to consume far more than it produces while the rest of the world is forced to pick up the check. Here's the secret to how it all works. America prints dollars, and those green pieces of paper are accepted globally as the world's reserve currency. That means every other country needs dollars to trade with one another, to buy critical resources like oil, to build their national savings, and to protect themselves from economic storms. And because the entire planet has to have dollars, the United States can print them endlessly without facing the immediate catastrophic consequences that any other country would. It's the equivalent of having a magical ATM in your basement while everyone on your street agrees that the cash it spits out is the only real money. It doesn't matter how much you print or how irresponsibly you manage your own finances. You can always create more, and people have to accept it because the whole system depends on it. Now I want you to imagine this. One morning, your biggest neighbor, the one with the most successful business on the block who has been faithfully collecting your homemade cash for decades, suddenly says, "You know something? I'm done with your paper money. I'm switching to a different standard. I'm going to use gold. I'm going to use my own currency. And I'm going to start dealing with our other neighbors, directly cutting you out of the loop entirely." That is a perfect picture of what China just did. And the fallout from this is absolutely enormous. But to really get why this is such a game changer, we have to dig deeper into the mechanics of this system and understand why it was always designed to fail. I've built my entire career analysing capitalism, its inherent flaws and its spectacular collapses. And I am telling you, the current dollar-centric global order is one of the most profound economic distortions in modern history. It's what allows the United States, a country with less than 5% of the world's population, to consume nearly 25% of all global resources. How is that even possible? It's possible because America can run colossal trade deficits year in and year out for generation after generation by just firing up the printing press for more dollars or issuing more dollar-denominated IOUs that other countries feel obligated to buy. Think about it like this. If you or I consistently spent more money than we earned each month, eventually our credit cards would be maxed out. The banks would cut us off and we'd face a very real financial crisis. Yet the United States has outspent its earnings for over 40 consecutive years, racking up gargantuan trade deficits. But instead of hitting a wall, its lifestyle has been continuously financed by the rest of the world buying up its debt in the form of US Treasury bonds. And for the longest time, China was the #1 foreign buyer of that debt. At its peak, China held over $1.3 trillion in US government securities. That is $1.3 trillion. To put that number into perspective, it's more than the entire annual economic output of a country like Mexico or Indonesia. What was really happening was that China was loaning the United States staggering amounts of capital. And America, in turn, was using that borrowed money to finance its sprawling global military presence, to pay for wars in places like Iraq and Afghanistan, to underwrite tax cuts for the super rich, and to bail out its largest corporations. This brings us to the obvious question: why on earth would China do that? Why would it agree to finance its main strategic competitor? This is the point where most mainstream explanations just fall apart. They'll feed you a simple story about a symbiotic win-win relationship. America got cheap money to fund its deficits, and in return, China gained access to the massive American consumer market for its factories. For years, we were told a simple story about how money moved around the world. Chinese factories made things and American consumers bought them often with money they didn't have. And all those dollars would circle right back to China, where the government would supposedly park them safely in US Treasury bonds, creating a perfect self-sustaining loop. But that convenient narrative completely ignores the massive power imbalance at play. The reality is China didn't have many other options. You see, when a country accumulates a gigantic trade surplus with the United States, they get buried in a mountain of dollars, and that cash has to go somewhere. It can't just sit in a vault gathering dust. It has to be invested. And for decades, the only market on the planet that was big enough, liquid enough, and supposedly secure enough was the market for US Treasury bonds. There was simply no other place that could absorb the colossal river of cash that China was generating. But there was a fundamental, dangerous vulnerability baked into this system, a fact that Beijing began to grasp with chilling clarity over time. By keeping the lion's share of its national wealth locked up in US debt, China had effectively given America an incredible amount of leverage over its own financial destiny. If the powers in Washington ever decided to freeze those assets, China could be cut off from over $1 trillion of its own savings in an instant. If Washington decided to fire up the printing presses and devalue its currency, the real-world value of China's holdings would evaporate. And if Washington chose to weaponize the financial system for political gain, a tactic it has used over and over against nations like Iran, Venezuela, Russia, and Afghanistan, China would be dangerously exposed. And this next part is the most important piece of the puzzle, so pay close attention. China watched like a hawk to see what the United States would do to Russia when the Ukraine conflict erupted in 2022. Washington froze roughly $300 billion of the Russian central bank's reserves. I want you to hear that again. The United States and its allies effectively confiscated $300 billion of a sovereign nation's foreign savings. No matter what you think about Russia or that war, this event marked a seismic shift in the history of global finance. It demonstrated beyond a shadow of a doubt that assets held in dollars, even the supposedly untouchable reserves of a central bank which are meant to be sacrosanct under the global financial rules, can be seized, withheld, and used as a political sledgehammer if a nation's actions run contrary to US interests. Now I want you to put yourself in the shoes of a top planner in Beijing. You're sitting on $800 billion down from over $1 trillion of US government bonds. You are fully aware that the United States sees you as its number one strategic competitor. The Pentagon has publicly identified China as its chief threat. The US is actively forging military alliances throughout Asia for the explicit purpose of containing your country's influence. It's hitting your goods with tariffs, blocking your access to essential technology, and making constant noise about a military defense of Taiwan. And through all of this, you have $1 trillion of your national treasure sitting in an account that this very same country could freeze with the stroke of a pen. What do? The answer is obvious. You start reducing your vulnerability, you diversify your assets, and you find other options. And that's precisely the playbook China has been running. Not in a panic, not in a chaotic fire sale, but with a calm, methodical, and highly strategic approach. The data from the US Treasury Department itself tells this story in black and white. China has been systematically dumping US debt for years. From its peak of more than $1.3 trillion, its ownership has cratered to less than $800 billion. That's a reduction of over $500 billion. That's $500 billion that is no longer financing the US deficit. That is $500 billion that China has since redeployed into other assets, different kinds of investments, and more secure stores of value. And China is not alone on this path. Japan, which for years was the second largest holder of American debt, is also scaling back its investments. Saudi Arabia, the very nation that forged the Petrodollar agreement with the United States back in the 1970s, is diversifying its investments and is now talking about selling its oil in Chinese yuan. Central banks all over the planet are snapping up physical gold at a rate we haven't seen in generations. Russia has already sold off nearly its entire stockpile of US bonds. India is hoarding gold. Brazil is striking trade agreements using their own local currencies. The entire architecture that propped up the dollar as the undisputed king of global finance is slowly beginning to fracture, and most people are completely oblivious because the mainstream news is more concerned with the latest celebrity scandal or some politician's angry tweet. Now let me get out ahead of the arguments from the defenders of the old system. They're going to say, Richard, this is a non-issue. The United States will always find buyers for its debt. The dollar is simply too dominant to be replaced. There's no viable alternative, and besides, China would only hurt itself by selling. Selling because it would just crash the value of the bonds it still owns. On the surface, those talking points might sound convincing, but they fall apart under the slightest bit of scrutiny. First, let's tackle this idea that no alternative to the dollar exists. That might have been true 2 decades ago. It is absolutely false today. China has been painstakingly building an entire parallel system to bypass the dollar. It launched CIPS, which is the cross-border interbank payment system, and it's basically China's own answer to the SWIFT network. Think of SWIFT as the global financial highway system, and the United States has massive control over the on-ramps and off-ramps, using it to impose its will on other countries. But with its own system, CPS, China is building a parallel highway to move money across borders, without needing to pass through any toll booths that Washington controls or monitors. On top of that, China is aggressively championing its own currency, the yuan, for international trade. They're inking currency swap agreements with dozens of nations and planting yuan processing hubs in key financial centers all over the globe. More and more, the price tags on the goods China sells to the world are listed in yuan, not dollars. But the bedrock of this entire strategy, the real power move, is gold. For years, China has been one of the planet's most voracious buyers of physical gold. They play their cards close to the chest and don't publish exact figures for obvious strategic reasons, but all the signs point to a hoard of thousands upon thousands of tons. So why the obsession with gold? Because gold offers something that US Treasury bonds simply can't. It can't be frozen, it can't be sanctioned, and you can't just print more of it into existence. It represents real tangible wealth that exists completely outside the whims of any single government. If the US decided tomorrow to lock up all of China's dollar assets, the gold would still be there holding its value. It's the ultimate financial shield against American economic might. Secondly, the argument that China would only hurt itself by dumping its bonds confuses a short-term reaction with a long-term strategic pivot. Of course, if China tried to offload all its bonds in a single day, prices would tank and the value of its remaining holdings would get hammered. That would be like trying to sell 100,000 shares of a company all at once. You'd crash the market by overwhelming it. But that isn't their play. They are methodically and patiently selling over the course of many years. They are slowly de-risking their position without setting off any major market alarms. It's the difference between a panicked stampede for the exit in a fire and an orderly planned evacuation. You still end up outside the building, but with far less chaos and damage. And this reveals a deeper truth that many dollar loyalists refuse to see. China is willing to absorb some manageable losses on its treasury portfolio if it helps them sidestep a much bigger strategic checkmate in the future. Think about it like this. If you held $1 million in an investment you were convinced was headed for a major fall, would you rather get out now for $800,000 or hold on and risk it becoming worth far less? China is making the calculated bet that it's smarter to take a controlled hit now than to be completely vulnerable later on. But the real problem for the United States isn't just that China is selling its bonds. The actual crisis is that America needs buyers for its debt more than ever before. Just take a look at the US budget deficits from the last few years. They're staggering. We're talking trillions of dollars every single year. The interest payments alone on the existing national debt now exceed $600 billion annually. And that number is only climbing as interest rates tick upward. The United States is caught in a debt spiral. It has to borrow new money every year just to pay the interest on its old debt on top of funding the entire government. So if the traditional foreign customers, China, Japan, the oil exporting nations, are all pulling back, somebody has to pick up the slack. So who ends up buying these bonds when the foreign demand dries up? The Federal Reserve, America's central bank. And there is a technical term for when a central bank buys its own government's IOU as debt monetization. To put it bluntly, it means the government is printing money to finance itself. And we just saw this play out on a scale we've never seen before during the pandemic. The Federal Reserve bought trillions upon trillions of dollars in Treasury bonds. Its balances sheet ballooned from under $4 trillion pre-pandemic to over $9 trillion at its peak. That's over $5 trillion created from thin air and injected into the system to buy up government debt. And what did we get? The worst inflation in 40 years. The cost of food surged by 2030, even 40%. The price at the pump shot up. Rents went through the roof. Real wages fell because paychecks couldn't keep up with the exploding cost of living. Working-class families got squeezed, while asset owners, people holding stocks and real estate, saw their net worth soar because all that new money inflated asset prices. This is what I call the class-based impact of monetary policy. When the Fed creates money, it doesn't rain down on everyone equally. It acts as a massive subsidy for those who own financial assets and as a tax on people who rely on a paycheck and whose savings are eroded by inflation. So when people ask me, why does this matter? Why should I care if China is selling some treasury bonds? Here's the bottom line. It forces the United States into a mathematical trap. Either the US government implements politically impossible spending cuts, or the Fed is forced to keep printing money to soak up the debt nobody else wants. That means more inflation, and which means your dollars buy less and less, which ultimately means your quality of life declines. There is no simple escape from this dilemma. This was always going to happen. It's the bill coming due for decades of living on the national credit card for funding foreign wars, with debt for slashing taxes on the rich while bloating the military budget, and for bailing out Wall Street while our own infrastructure crumbled. This is the long overdue reckoning for those choices, and it's snapping into sharp relief. And let's be blunt about something else. This is not just about numbers on a spreadsheet. This is about one thing: control. For more than 50 years, the dollar-based system has been the bedrock of America's global power. It's what has allowed the United States to maintain hundreds of military bases scattered across the globe. It's how the US can financially cripple any nation that steps out of line simply by kicking them out of the global banking network. It's what has fueled a military budget that outspends the next 10 countries put together. All of this power hinges on the dollar's privileged status, and if that status erodes, the entire edifice of American influence begins to crumble. Now I know what some of you are thinking. I hear it all the time. People will say that China has its own set of massive problems. Their real estate market is a time bomb. Their population is aging rapidly. Their once unstoppable economic growth is hitting a wall. They argue that China could never really challenge the United States, and every single one of those points is true. China is absolutely facing enormous internal weaknesses. But you're missing the point. This isn't a story about a perfect China coming to replace an aging America. This is about the rest of the world getting tired of putting all its eggs in the American dollar basket. This is about diversification. It's about wanting other options. For the first time in 50 years, countries have real alternatives for where to park their wealth, which currency to trade in, and how to insulate themselves from financial chaos. And they are starting to act on it. Just look at the rise of the BRICS nations: Brazil, Russia, India, China, and South Africa. As a group, their economies are now larger than the G7. They're in serious discussions to create a common currency just for trade between themselves. They are launching their own development banks that go head-to-head with Western-dominated institutions like the World Bank and the IMF. And get this: Saudi Arabia, America's most critical Middle East ally for decades, is now openly considering joining them. They're talking about selling their oil in Chinese yuan. A decade ago, that would have been unimaginable. The petrodollar system, the agreement that oil is priced exclusively in US dollars, has been a critical pillar holding up the dollar's power. If major oil producers start accepting other currencies, that pillar starts to crack. And this isn't just about the BRICS. Countries across the planet are cutting deals to bypass the dollar, entirely trading in their own local currencies. You see it between Argentina and Brazil. You see it with India and Russia trading in rupees and rubles. China and Saudi Arabia are working out deals to conduct trade in yuan. Each one of these deals is just a small crack in the dam, but taken together, they reveal a powerful current, a slow but steady exodus from dollar-dominated trade, and central banks are voting with their wallets. The data from the International Monetary Fund is undeniable. The dollar's share of global reserves has plunged from over 70% 2 decades ago to just 58% today. That's not a blip, that's a trend. And gold, as we've discussed, is being hoarded at historic rates. Central banks snapped up over 1,000 tons of gold in the last year alone. They are swapping US government IOUs for a hard asset that cannot be frozen or sanctioned at the push of a button. So this brings us to the essential question facing the United States. How do you maintain the dollar's special privilege when the world isn't willing to give it to you for free anymore? And this is where the options on the table get very narrow and very dangerous. Option 1. America gracefully accepts a new multipolar world, one where the dollar is still a major player, but no longer the undisputed king. This path would require tremendous humility. It would mean overhauling global financial institutions to give developing countries a bigger seat at the table. It would mean acknowledging the real-world limits on American power. Frankly, this seems like a fantasy. No one in Washington is prepared to voluntarily surrender that kind of advantage. Option 2. The United States tries to strong-arm the world into sticking with the dollar through coercion. That means more sanctions, leaning harder on allies, and potentially even direct military moves to seize control of strategic resources or shipping lanes. This is the high-stakes gamble, because it risks escalating an economic competition into a hot global conflict. And honestly, given the recent track record in places like Iraq, Afghanistan, and Libya, it's an option we have to assume US leaders would seriously consider. Option 3. The US just keeps kicking the can down the road, printing more money to plug the holes, piling up ever more debt until the day the system finally breaks. a day when the bond market seizes up, interest rates explode, and the economy is thrown into a brutal depression. This is the hard landing scenario, and every year that passes without serious reform makes it more and more probable. Option 4, and the one I see as most likely, is a gradual fracturing of the system. The global economy doesn't collapse, but it splinters into currency blocks. You'll have a dollar bloc centered on the United States and its closest partners. You'll have a yuan bloc built around China and its vast network of trading partners, and perhaps even other regional currency zones as well. The globe is becoming a much rockier, more unpredictable place where clashes are almost guaranteed. But don't expect one big dramatic implosion. Think of it as a slow grinding decay of the old way of doing things, which brings us right to the doorstep of China's decision to offload American debt. China's move wasn't just a financial transaction, it was a broadcast to the entire world. It was a demonstration that they have other plays to make, that the dollar no longer has them cornered, and that they can safeguard their nation's wealth from what they consider reckless moves being made in Washington. And that signal is being received loud and clear in the halls of power across the globe. Other world leaders are taking notes. They see China pulling this off. They're realizing life outside the dollar's orbit is possible. They're starting to understand that the veneer of America's total financial supremacy might be thinner than anyone thought. And once that perception catches on, the whole process starts feeding on itself. More governments start dumping their bonds, which forces interest rates to spike. That makes it harder for the United States to borrow, which forces it to generate more currency, which ignites inflation, which shatters confidence in the dollar, triggering even more bond sales. It's a vicious, self-perpetuating cycle. It's the polar opposite of the positive feedback loop that kept the dollar on top for so long. So what does this actually mean for you, the person watching this at home? It means the fundamental world you were brought up in. The world where America set the terms, where the dollar was the undisputed champion, and where our country could consume far more than it produced without any immediate blowback. That entire reality is crumbling. And this will have tangible consequences for how you live your life. When the dollar's purchasing power falls, goods from overseas get far more expensive. That translates to higher prices on practically everything from your smartphone to your shirts to your groceries. When the United States has to fork over more money for interest on its debt, that means less cash is available for everything else. We're talking about education infrastructure and social services. If a budget crisis hits, we could see devastating cuts to the programs millions of Americans rely on to get by. If the global economic system fractures, you could start seeing real supply chain disruptions, shortages of goods, and significant job cuts in any sector that depends on global trade. This isn't some far-off abstract economic debate. This hits you right where you live, your ability to make rent, to afford food, and to plan for your future. And the most frustrating part for me is that none of this should be a surprise. For years, economists willing to look past the official narrative have been waving red flags about these exact issues. We've been making it clear that you simply cannot finance global dominance on a credit card forever.